So you introduced the topic, the deferred sales trust. So let's talk about those proceeds from the sale of the property. How is it that the mechanics of this, that you have the property, you sold it, you were seeking to do a 1031 exchange, but now you've decided, now maybe I won't do a 1031 exchange. I'm going to do deferred sales trust.
Yeah, first of all, understand it's not a 1031. It's not a Delaware statutory trust. Don't get these two confused because DSTs often get confused. The key thing, the foundational understanding of how this works is IRC 453, which is known as an installment sale or a seller carryback. So as the client, if you're selling the deal, Darrin, you're going to lend the funds to the trust in exchange for a promissory note. You're typically going to take 100% financing, back. You're going to take all. You're not going to give any down payment from the trust. You're going to give all the financing to the trust. And when you do it like that, you haven't received any cash payment. Therefore, you're in a tax deferral state. Then we find the third party buyer, and that buyer actually buys it from the trust and infuses the cash into the trust. And the trust buys and sells for the same price. Therefore, there's no tax at the trust level. And since you sold it and you received no down payment, you're in a deferral state. It's not unlike an IRA or even a 1031 if you think about it, right? Think about how a 1031 works. If you sell a property, let's say for $10 million, you have zero basis, and all the funds go to the qualified intermediary instead of going to you, well, you haven't received any of the funds yet. They're at the qualified intermediary. Or even like an IRA works, that way the IRA works is the government says, look, if you put money into this IRA, as long as you don't touch it or take distributions, it's in a tax deferral state. It's building and growing. So same thing with the trust. We form a trust. The difference is you don't own the trust, you lend to the trust, and then the trust will slowly pay you over time in installments, and you'll pay the tax. So we just closed the deal in Alabama, it's a $2.6 million business sale, and he owed about $600,000 of tax. Again, didn't qualify for a 1031, but he's a business. It did qualify for the deferred sales trust, so he moved it into the deferred sales trust, sold it to the ultimate cash buyer, which was his partners that bought him out. And then he is building 70 units in Tennessee right now, all tax deferred ground up development. So it's a really nice way to go on to that next thing. The key is, as long as it's in an investments and as long as it's out there, it's in a tax deferral state until when? Until the income starts producing on the trust and you start receiving payments. Well, when do you receive payments? Well, some of them receive it right away. Some clients, we just did a deal, a $1.4 million primary home sale for a retired teacher. And she was on a fixed income. She lived in the house for 25 years, and she's able to sell her house that she bought for about $200,000 for about 1.4 and defer all the capital gains tax. And now she's going to live off the interest payments of the trust over the next 10, 20, 30, 40 years, pass it to her children who can continue it on as well. And so it becomes a nice vehicle to not only defer tax, but to live off the cash flow.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.